Successful investing does not require a high IQ, insider information, or luck. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from ruining them. In The Intelligent Investor, Benjamin Graham presents exactly such a framework. His investing strategy has been one of the most successful over the past 100 years, proven not only by Graham himself, but also by his most famous disciple, Warren Buffett. Here are the actionable 5 key takeaways from The Intelligent Investor by Benjamin Graham. Takeaway 1. Meet Mr. Market. Imagine you own a share of a business. Every day, a bipolar character called Mr. Market offers to buy or sell your share at a different price. Sometimes he's wildly optimistic, other times deeply pessimistic, often completely detached from the actual value of the business. A stock is not just a ticker symbol, it's partial ownership in a real company. Mr. Market's mood swings create opportunities. You should happily sell to him when his price is ridiculously high and buy from him when he offers a clear bargain. But you are never forced to trade with him. When his offers don't make sense, simply ignore him. Takeaway 2. How to invest as a defensive investor. Most people should follow the defensive passive approach. This involves maintaining a balanced portfolio, for example 50% stocks and 50% bonds, and rebalancing once or twice a year. Use dollar cost averaging. Invest a fixed amount at regular intervals. For the stock portion, focus on large, conservatively financed companies with a long history of profits and dividends, strong financial health, and reasonable valuations, low PE and price-to-book ratios. Alternatively, simply investing in a broad index fund can deliver market average results with minimal effort. Takeaway 3. How to invest as an enterprising investor. The enterprising, active investor is willing to devote significant time and effort to beat the market. This requires discipline, patience, and thorough analysis. Focus on undervalued companies rather than glamorous growth stocks. Look for businesses trading at a significant discount to their net asset value, ideally even below their net working capital. These opportunities are rarer today but still appear during market downturns. Focus. Takeaway 4. Insist on a margin of safety. The biggest risk in investing is being wrong in your assessment. You can reduce this risk by always demanding a margin of safety, buying assets well below their calculated intrinsic value. Graham suggested buying when the price is no more than 2/3 of the conservatively estimated value. This buffer protects you if your calculations are off or if unexpected problems arise. A takeaway 5. Risk and reward are not always correlated. Academic theory says higher returns require higher risk. Graham disagreed. When you buy $1 worth of value for 40 or 60 cents, you can actually achieve higher potential returns with lower risk. True risk comes from overpaying for assets, not from price volatility. The intelligent investor focuses on the gap between price and value. Final thoughts. The real edge from the intelligent investor comes from emotional discipline and a rational framework. Treat the market as a servant, not a master. Insist on a margin of safety, and never forget that a stock represents ownership in a real business.